So you've heard you can invest into residential property using your superannuation fund, but you're not sure how to do it. First thing you need to know is that your everyday run-of-the-mill retail or industry super fund won't be able to do that for you. You need to set up what's referred to as a self-managed superannuation fund. And this is how it works. You can have up to 4 members maximum inside a self-managed super fund. Commonly, we see 2. We see 1 couple. Every superannuation fund in Australia is governed by a trustee. And the trustee is the entity or the individuals that set the rules as to what members can invest into. It's the trustee that are legally responsible for what happens to members' money. In a self-managed super fund, members have to be trustees. We set this up as a company structure, so the members are directors of that corporate entity. So in other words, the members are legally responsible for what happens to their own money, hence the term self-managed. Because it's self-managed, you can then write the rules as to what you can invest in, and that's where we can broaden the net and stipulate that you want to be able to invest into residential property. The second benefit you get is the members can pool their money together in a bank account for the purpose of investing in assets in the future. Okay? So we have to keep a very clear record as to what the individual balances are on paper, but in practice we can squish the money together for the purpose of building future assets. So in this example, we're going to assume that these 2 members combine have $200,000 in combined superannuation assets. And they want to go buy an investment property over here, but we know that they don't have enough cash in super to pay the whole lot, so they're going to ask the bank for a loan to help them out with the purchase, and the bank will do that and take security over that property. And members will start to repay that bank loan. Now, what happens if the members don't repay that bank loan? First of all, the bank will simply repossess the house. The concern for the bank is if they repossess that house and the house is valued at less than the loan that they're owed, because the bank can't come back to here and just grab the excess money that they're owed. Superannuation in Australia is capital protected from bankruptcy. So the bank does 2 key things. 1, they will ask the members for a personal guarantee over their own assets. That means if the bank still owed money once the house is sold, then they will go to the members personally and ask them to sell personal assets to repay their debt. So you're still on the line for the liability. Okay? But the good thing is it doesn't chew up the equity in your own home. So if you've still got a home mortgage that you want to focus on, or you want to use the equity you've built in your own home to buy maybe another investment property, it's not going to slow that process down. The second thing they do is limit how much they will lend people under this structure. Currently, 70% against a residential property is the maximum any lender will borrow against. So you can kind of see at this point that we do need to have a degree of separation between the bank and the super fund, so the bank can't get tidied up with any of the excess cash that's sitting in the fund. How we do that? We have to own this property under a separate trust. It's called a bare trust. Bare in the sense that it's clean, it's empty, it's not used for any other purposes. Because it's a trust, it has a trustee, which is set up as a company with the 2 members of the fund being the directors of this corporate structure. So it looks like we're duplicating a bit of paperwork at this point. This entity here becomes the legal owner of the property. Then there's a legal agreement that gets done for you. It's called a limited recourse borrowing agreement. And that really says legal owner, and the super fund is the beneficial owner. And that allows things like the rent to be paid into the super fund to complement the employer super contributions, or the 9.5% that you get paid into superannuation normally. And then we go and have to pay some operating expenses. As far as the expenses, there's two key aspects you've got to look at when assessing the affordability of this strategy: the capital and the cash flow. So the capital is how much money have I got in the pot, and have I got enough to make this work initially? Once I know I can afford to purchase, what is the ongoing income and expenses attached to the strategy, and can this work without me having to contribute lump sums into super all the time? You don't want this strategy to be a negative cash flow strategy. Okay? So let's just say you wanted to buy a property worth $400,000. We know a bank's going to lend 70% of that, which in this case is $280,000 in a loan, which means you've got to come up with $120,000 to make this work. plus your costs. You cannot borrow for costs in a self-managed super fund. Your biggest cost in this instance is going to be your state tax, it's going to be stamp duty, but there's other costs in setting up the infrastructure, legal fees, advice fees, that sort of thing. So I'd probably allow at least $20,000 to do that. So at this stage, we've taken the amount that we need in super to $140,000, leaving us with about $60,000 left over. Now, the Australian Tax Office, the regulator for self-managed super funds, has come out with a guideline that says that when a property is settled, they want to see superannuation funds with liquid assets, meaning bank account or shares, anything that can be turned quickly into cash, of 10% of the fund value. They're concerned that investors are bleeding superannuation funds dry and not leaving them with any backup if you get hurt, lose a job or anything like that. So if you've got it excludes debt. So if you've got a $400,000 property, as a minimum, they're going to want to see at least $40,000 in a bank account. So if you're looking at a rule of thumb, $400,000 purchase, you really want a minimum of $200,000 before you even start the discussion of what is the ongoing expenses. When you get to the ongoing expenses, we need to look at what's the rent, what super contributions are going in, what's it cost me to run this strategy going forward. They're going to be things like tax returns, audit fees, you're going to have property insurance, you're going to have landlord insurance, you're going to have rates on your property, property managers fees. There's a number of different expenses associated with property ownership. You need to do those numbers carefully before you enter into this strategy. The benefit of it is you are using other people's money to make money, and that can be a really good strategy to build your wealth in the future, albeit there are certain risks attached with it. To find out more, tailoredwealth.com.au.